all in one.
710 WOR's Mark Simone Show continues. Once again, here's Larry Mendte.
There has been some rumbling about a recession next year. Now, I think we already had a recession because we had 2 quarters in a row that the GDP contracted, but they've changed the rules and said, no, that's not a recession anymore. So now we're expected to have a recession next year, with the Feds doing everything to bring down inflation, which means interest rates are also going up. They've already gone up. And despite everything that you've just heard, the Fed is trying to do, Treasury Secretary Janet Yellen, who is, by the way, the dullest person in Washington. And that's really saying something because Mitch McConnell's there. But despite everything, Yellen says that high inflation is going to stick around for a while. That's what she said on 60 Minutes. She's shocked Savannah Guthrie, the CBS anchor, who said, really? Really? I think if you saw the report, you heard her surprise because we were told inflation was temporary, that it was transitory. Let me introduce you to someone who I'm sure isn't taken by surprise by any of this. He spends every waking hour studying this stuff. Well, maybe not every waking hour. He has to have some fun sometimes. Thomas Hayes is the founder and chairman of Great Hill Capital. You've seen him on Fox, CNBC. He's been in the Wall Street Journal, basically everywhere. Tom, thanks for making time for us today. I really appreciate it.
Thanks for having me on, Larry.
Hey, so I guess the key question for people is they hear all of these things. They hear Janet Yellen saying inflation's going to stick around. They see what the Fed's doing. They hear the word recession, and they've seen their 401ks diminish. And so the question is, what do you do now?
Well, Larry, these are the exact same people who last year were predicting the Fed funds rate would not get above 1%, and here we are at 4.25% to 4.5% a year later. So their history of predictions are not that accurate. They tend to overshoot on both sides, and that's exactly what they're doing right now. But I want to put this in context because in 1981, 82, we had a similar situation, a bout of inflation, even more aggressive than right now. And the S&P dropped 27% peak to trough, which is about what we did this year. Many people know from their 401ks. And what changed, and it can change overnight, even with inflation right around 7%, which is right where we are right now, Paul Volcker came out after an aggressive hiking cycle, similar to what we're having, although it was at higher levels, and he said the magic 3 words. He said, quote, "We may shift tactics." Within 4 months, 100% of the losses in the S&P 500 were made up. By the next year, we were at new highs. I'm not saying that's necessarily going to happen next year, but what I am saying, Larry, is probably the outlook for next year. Economy, a little bit slower because of all the tightening and the lagged effect. Stock market, a little bit better, okay? And that sounds like a contradiction, but what we find if we look back all the way back to 1954, the last 6 cycles, the stock market bottoms 6 to 12 months before earnings bottom. So if you believe all the naysayers and all the bears out there saying, earnings have to come down another 10 to 20%, well, history dictates if they're right, which we don't know that they will be because the economy is doing a little bit better than I think people are giving it credit for, then you'd want to be buying high-quality businesses that have been marked down.
Explain that comment you just made, that the economy is doing better than we're giving it credit for, because it feels awful.
Yeah, there's no question. The sentiment is certainly awful. What you're seeing, you're seeing the positioning awful. Managers have built up the most amount of cash that they have since April of 2020 and March of 2009. What the common denominator is between both of those events is that pessimism was at its highest and the stock market bottom was in the rearview mirror. Analysts have been calling for 20% down in earnings for the last 6 months, and what we've gotten over the last 12 months, despite all the tightening, despite all the policy mistakes, is we've had estimates for 2022 come down about 7-8% over the last 6 months. So I think people are underestimating a few things. Number one, the dollar has started backing off. Why has the dollar backed off? Because it's sniffing out that the Fed is closer to the end of the tightening cycle than even the Fed will admit. And when the Fed actually does pivot, like the May shift tactics wording, they're not going to give you warning. They're not going to say, hey, Larry, time to buy equities because in February we're going to say we're done. But, so history says you have to start to take advantage. And I'm not saying go out and buy wholesale everything. But when you look at some of the high-quality businesses are going to be doing much better three years out, like the Disney's down over 55%, with park business up 36% quarter on quarter. They just have to bring in expenses, which Iger is now going to do. Like the Amazons of the world, down 55%. How many boxes do you get every single week? The digitization of the cloud is going to continue to grow. They just built too many warehouses during COVID, and they'll back those costs down, and they'll be off to the races. But you got to give these things 1, 2, 3 years. But when you get these blue chip, high quality stocks that are on sale, we're in the market and we're buying them. Wall Street is the only place in the world, Larry, when they hold a clearance sale, everyone runs out of the store versus into it.
Tesla is down 58%. Would you buy Tesla?
That goes in my too hard box. I've never owned it. I've never shorted it. I think the guy is a visionary. He has a proven track record of success. It's a little too rich for me, but it doesn't mean it can't go up. It's just, some things I got to just put in the too hard box.
I only ask you that because I'm going to be talking about Elon Musk in a few minutes. And Elon Musk, as much as he is a cultural figure right now and seen as a villain by one side and a hero to the next, he is also a businessman and runs several companies. So you have Twitter and you have Tesla, and both of them seem to be suffering. Is it political or the fundamentals that bad?
Yeah, there was some worries about orders in China. I think that those worries are unfounded. The Chinese government finally had to blink when there were people out on the streets, and they risked another Tiananmen Square from keeping people locked up in their apartments with the zero COVID policy. They've now reversed that. And speaking of which, I think that leads to what we see as one of the biggest opportunities over the next 2 years, 3 years, is emerging markets. You can buy a basket of emerging markets at 2007 prices 15 years ago. If you consider the amount that GDP has grown since then, it's absolutely a bargain. And why have they been subdued? Well, they've largely been subdued, particularly in the last year, because it trades inversely to the U.S. dollar. And what we've seen in the last 2 months is finally the dollar has stopped going up because it's anticipating Powell pausing at some point in early 2023. And as that dollar stabilizes and even starts to come down, emerging markets will get bid. We see this over and over throughout history. From 2002 to 2007, after the dollar started weakening, emerging markets were up 480%. 2009 to 11, dollar starts weakening, emerging markets up 189%. 2016 to 2018, 96%. 2020 to 21, 97%, because they've been buying all the oil from Russia at $60 a barrel. So they've stored all of this oil. They've got no worries about inflation, which means they can be loose on the monetary policy while we're being tight. They can do fiscal policy. They can crank up the economy. And just last week, they set their GDP at 5% for 2023. So that's going to help S&P earnings. It's going to help emerging markets. And I think those are some of the places you want to be moving forward.
Well, Thomas, I didn't expect that at all. That was pretty darn optimistic for next year. A comeback in the stock market, a comeback in the world markets, everything looking better. I'm not hearing that from anybody else, so I'm in your camp.
The only thing that's going to be the cloud is that what's going to confuse people in 2023, Larry, is you're going to see unemployment tick up while the stock market ticks up. And that's going to be the head scratcher for everyone. And you could even see earnings being more subdued and the stock market goes up because the stock market did its work as a discounting mechanism. You don't drop 35% peak to trough on the NASDAQ and 25% peak to trough on the S&P. because there's no slowdown. But the key is how much of that is priced in. And I'm saying in these discrete areas, we believe quite a bit of it, if not all, has been priced in. And that's where we want to selectively be taken advantage of. Because if you wait for the robins to sing, this is what Buffett always says, if you wait for the robins to sing, it's already spring and you missed it. So selectively, it's time to ease in our view.
All right. Thomas Hayes is the founder and chairman of Great Hill Capital. Always great stuff, always next level stuff from him. So it sounds like Thomas Hayes is predicting tentatively a bull market for the coming year, and that's great. Thomas, always thank you so much. You're always a wealth of information. I really appreciate it.
Thanks for having me, Larry. Always enjoy it.
When we come